Palo Alto Networks stock is up over 17% year to date in 2025, and I'm happy about that. I've been on the fence about this company. I've had it rated as a borderline buy, and so today I'm going to take a microscope to the company and update my recommendation if I think it's buy, hold, or sell, or somewhere in between. Let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Palo Alto Networks has demonstrated excellent revenue growth over the previous decade, increasing from 900 million in revenue, more than 10xing to 9.2 billion in trailing 12-month revenue in the most recent trailing 12-month period. One of the things the company has changed recently is a policy to attract new customers by telling them, look, you can join us. And if, let's say, you have a 9 month remaining on your contract with one of our competitors and you don't want to be paying two providers at the same time, we'll let you join us, use our services, and you don't have to pay us until your contract is up with our competitor. So whether that be 9 months, 12 months, 15 months, you don't have to pay us until your contract is finished with whoever it is that you're with right now. And Palo Alto Networks started that strategy more than a year ago. And initially, when they started that strategy, I was concerned about the overall cybersecurity industry because typically, when one of the leaders makes a move like that, a strategic move to gain market share, the competitors will follow with similar moves or not exactly the same kind of a move, but with moves to try and retain or also gain market share, right? It increases competition. And you know that looking at my book, so competition is one of the six most important steps in my 6 step framework for evaluating stocks. So when competition is increasing in that way, the risks to an all-out price war increase. And so in the months following that move by Palo Alto Networks, I was watching the cybersecurity industry closely to see if rivals will follow suit, and they haven't. And that's been great news. So for the most part, this move by Palo Alto Networks hasn't been responded to by major competitors around the industry. So I've been happy with the competitive dynamics in the cybersecurity industry following that move more than a year ago from Palo Alto Networks. And so this move has worked well for Palo Alto Networks in attracting new customers, in attracting customers maybe sooner than otherwise might have been. And the industry has weathered this move relatively well. So as you might imagine, Palo Alto's return on invested capital has dipped as a result of that move. If Palo Alto Networks is providing these services to new customers without getting payment from these customers, they're using company resources without getting capital, without getting cash from customers, it's going to be negative for its returns, for its margins, and it has been, right? So its ROIC has fallen significantly from 13.3% in the trailing 12-month period ending 2024 down to 3.6% in the most recently updated trailing 12-month period. This is some of the concerns I had about this strategic move. But as these customers start monetizing when their contracts with competitors are completed, Palo Alto Networks will start generating revenue from these newly acquired customers, and the ROIC is likely to recover and return to its trendline improvement. You can see from 2017 to 2024, its ROIC improved from negative 7.7% to 13.3%. So temporarily, it's going to experience this big negative, which is something I was expecting and something I was concerned with from Palo Alto Networks. And we're seeing that from the company's ROIC. That being said, I do expect that its returns will recover and improve as the initial influx in new customers on these so-called free trials return and start to monetize. I think the company's ROIC will improve. So its operating cash flow to sales ratio hasn't seen that big decline as a result of these strategic moves, similar to its ROIC. And you can see that. But what has happened is a flatlining of the improvement. So since 2020, the company's operating cash flow to sales ratio had been improving meaningfully from 30% all the way up to 40%, but that improvement has flatlined, right? It's remained at 40% for these previous 2 to 3 years instead of demonstrating that continued improvement and a return to levels, its peak levels of 47, 49% in 2016, 2017, which had fallen because of, again, strategic moves from the company to gain market share to reaccelerate revenue growth. And so it's in a flat level here. But again, this is another metric where I'm relatively confident that when these free trials start to end and they start to monetize these newly acquired customers, that the cash flow to sales ratio can improve to its industry leading levels in the next, I want to say, 18 to 36 months. With valuation, now that we looked at the company's important performance metrics, I wanted to look at valuation. But let me give a shout out to Fiscal.ai, my preferred data provider. All of these charts I'm getting from them, you can see the link in the description if you're interested in Fiscal AI and these cool charts here. So they're trading at a forward price to earnings of 56, which is about the middle of the valuation they've traded for according to this metric, right? So there's been times when this stock has traded at a cheaper valuation, most notably in late 2022, early 2023, as a result of several factors. Remember, these were the times and moments when market participants feared a recession. And so tech companies were trading at lower valuations, and especially cybersecurity companies, because investors feared that if we're going into a recession, enterprises are going to look to areas where they can cut costs, and they might look to cybersecurity providers like Palo Alto Networks as an area to cut cost and cut spending. They might call up Palo Alto Networks and say, we're looking for savings. Can you provide us some savings? If not, then we might look for cheaper alternatives for cybersecurity instead of paying the premium prices for Palo Alto Network services. And so the valuation of Palo Alto Networks dipped to relatively low valuations. And then since then, the valuation has now recovered as worldwide market participants have been confident that we're not going to go into recession, and the central bank is now started cutting interest rates. So the markets are not as worried about a recession as they were in late 22, early 23. We've been in a 3-year bull market, and so valuation has recovered to average levels of 56, which I would say is relatively fairly valued for a business like Palo Alto Networks, the kind of revenue growth and profit margins it generates. A forward PE of 55 in its industry, I think is a fairly valued business. But when I look at Palo Alto Networks on a discounted cash flow basis, the stock looks expensive. It's trading at a market price of 213, which is near its 52-week high of 218. But the intrinsic value I calculated for the business is $130. So it looks overvalued based on my DCF basis. So you can understand why I've been on the fence about this company. I've had it rated as a borderline buy all year long here, just about in 2025. And I feel about the same about the company. I like its long-term prospects. I like the cybersecurity industry. I like the competitive dynamics, even after a strategic move to increase market share. The industry did not go into this price war, this battle for market share, so I've liked that. But the valuation on my DCF is giving me hesitation, and the forward PE is not cheap. It's relatively fairly valued. It's a premium priced stock. It's not a cheap stock. So all that being said, I will reiterate my borderline buy recommendation for Palo Alto Network stock.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.